Thank you, Ryan and Adamas Intelligence, for having Rodney and me participate in today's conference. Critical mineral supply chains have become a very hot topic, and this conference focused exclusively on North America is very timely. I will speak today about what is set to become a very aggressive North American scramble for lithium assets. It was great to hear the updates from so many of our clients this morning. For those of you who are not familiar with RK Equity, we have been in business nearly 20 years, with a particular focus over the last 12 as investors in and advisors to lithium and other battery materials companies. We have focused the majority of our time with companies and projects in North America and Europe aimed at supplying demand in North America and Europe. This disclaimer references which companies we currently have equity interests in. Please note, RK Equity is not a financial advisor, and nothing we say should be construed as investment or financial advice, so please do your own research. I referenced in my Lithium Ion Bull newsletter at the start of 2020 that lithium equities seem to be following the Chinese zodiac. Green is bullish, red bearish, and yellow somewhere in between. 2016 was the year of the monkey, a lithium Curious George. 2017's rooster turned out to be a false dawn, as 2018 and 19 turned into the years of the lithium dog and the lithium pig. Following 2020's COVID bat, the year of the rat, in 2021, which Rodney telegraphed to be lithium's year on January 2nd, has very much been the year of the ox, a raging lithium bull. Coming soon is 2022, the year of the tiger, which I've been calling FOMO lithium. A lithium equity melt-up is a distinct possibility. Because commodity equities follow commodity prices. When lithium was 13,000 in June, Rodney predicted 20,000 by the end of the year. It was a bit conservative. Benchmark Minerals highlights China carbonate now at all-time highs of 28,000 plus, and they're suggesting it could be an unprecedented 40,000 not too far in the future. In addition to RK Equity's vodcasts, like our most recent one with Ryan Castillo at Adamas Intelligence, we have started a series of short Q&A with Rodney Hooper videos covering specific topics like North America's scramble for lithium, which also inspired the title of this presentation. Please visit and subscribe to Rockstock channel on YouTube and register your email at rkequity.com. Lithium is abundant in the Earth's crust, and the USA and Canada is very, very lithium rich. Carolina, Quebec, Ontario, a North American lithium triangle is poised imminently to emerge in these mining, processing, and investment-friendly jurisdictions. Just as Australia's spodumene to hydroxide has come to dominate battery-grade lithium supply for the highest performing nickel-rich vehicles, the conventional spodumene projects on this map are secure, scalable, and sustainable, and in my view, will soon be seen as strategic sources of supply for Tesla, Ford, GM, Stellantis, and other non-American auto OEMs operating in North America. You've heard today from Piedmont Lithium, Frontier Lithium, Critical Elements, and the newest entrant, Winsome Resources, all at various stages of development. Sayona has been one of the hottest stocks on the ASX this year, partnering with Piedmont to buy what could be the fastest brownfield restart in North American lithium. I'm very much looking forward to hear from Livent and Pallinghurst their plans for Nemaska, as well as Allchem's plans for James Bay. And no doubt, new exploration stories will soon appear. 2021's year of the ox has also been the year of the DLE unicorn. Will a DLE lithium triangle emerge in Western North America? E3 in Alberta and Compass Minerals in the Great Salt Lake of Utah are not as well known as market darlings Standard Lithium, Vulcan, Lake Resources, and Lilac, which presents an opportunity for E3 and Compass to catch up, in my opinion. Is there such thing as a lithium free lunch? The market value of Lanxess, a nearly $6 billion market cap chemical producer, has barely risen in 2021, despite the $2 billion value for Smackover implied from its 70-30 expected joint venture with Standard Lithium. It was great to see Compass Minerals publishing yesterday its battery quality hydroxide results and the appointment of Chris Yandel from Albemarle to lead their lithium development efforts. Elon Musk says there's enough clay lithium in Nevada to supply all his aspirations, and that's no doubt true. But what's the timeline and cost? How does Tesla's patented acid-free route compare to the acid-rich flow sheets that other projects are advancing in the region? And finally, if he's not worried about lithium, why is he building internal hydroxide capacity from spodumene? Is Sibanye-Stillwater's $490 million earn-in to 50% of Ioneer's Rhyolite Ridge a benchmark for other sediment plays? A defining moment awaits Nevada Clays next year as outstanding court cases for Lithium America's Thacker Pass will be decided by Judge Dew in Reno. On a recent vodcast, Reg Spencer of Canaccord said, "If I was VW or Ford or GM, I'd be panicking. OEMs are in the most need of increases in supply. We really need to see those guys write checks." As my friend Emily Hirsch says, America writes papers, China writes checks. It was good to see the White House report in June, and last week's Wilson Institute had some good ideas. But it's time to see the money. Will Jigar Shah at the Department of Energy Loan Projects Office write $500 million plus ATVM checks for lithium development projects, as the Loan Projects Office did to help fund Tesla in its early years? Piedmont Lithium announced last month that it is applied. I observe that North Carolina, a purple battleground state, has 15 electoral votes. It also has a retiring Senate seat that will be hotly contested. China walks the talk and knows where its money is welcome. China state-owned gold, copper, and zinc miner Zijin Mining entering lithium with a $770 million premium bid for Neo-Lithium has made China-Argentina projects hot once again. Big sums have also been invested in China Africa and Chinamlo, Bacanora Clay in Mexico, following previous year's investments in China Australia and Chilena. Tangxi investing $4 billion in SQM at the top of the market. I expect over the next few years that we will see USA and Canada maps look like China's for spodumene, 20 converters and growing, as well as DLE brine and clay mining and conversion in the USA and Canada. When Tesla suggested last year a 33% reduction in lithium costs, I think they were assuming a long-term view of $12,000 hydroxide, reduced to $8,000 by Tesla buying spodumene in Carolina and doing conversion themselves in Austin. A key focus of Tesla is a localized supply chain, 80% reduction in kilograms per kilometer, for manufacturing efficiency, for supply chain resiliency, and for sustainability. The best way to reduce carbon footprint is to stop shipping materials 9,000 kilometers before refining them, said Tesla's chairwoman, Robin Denholm. The cathodes are coming. Like Tesla, its co-founder, Jamie Straubel, is focused on shortening supply chains. It will be many years before Redwood achieves 100% recyclability. Meantime, they will need a lot of virgin lithium. Thank you to James Frith, a recent vodcast guest, and Bloomberg NEF's Battery Bull for this timely slide yesterday following the tsunami of new battery announcement in recent days. Strangely, Tesla Texas is missing, but the new highlights include Stellantis LG Energy Solutions 40 gigawatt hours by 2024, Stellantis and Samsung SDI, Britishvolt 60 gigawatt hours in Quebec, Stromvolt 10 gigawatt hours in Ontario, Toyota 3.4 billion through 2030, and Koch and Freyr $70 million investment to help commercialize 24M's technology in the United States. Ford CEO Jim Farley, like Tesla, recognizes where the real cost is. Channeling his predecessors in the 1930s and 40s, the supply chain has got to go all the way back to the mines. We have to solve these things, and we don't have much time. Ford and SK's $11.4 billion for 129 gigawatt hours equates to 100 to 125,000 lithium hydroxide tons, equivalent to 3 to 4 integrated Carolina lithium projects. My last few slides make the argument that in 2022 and beyond, we very well may see a return to Fordlandia, auto and/or battery OEMs actually buying and building mines and chemical plants for supply security and to control their own battery input costs. Assume Blue Oval City procures 100,000 tons of hydroxide from Albemarle or other producers at $20,000 a ton. This equates to $2 billion a year or $40 billion over 20 years. If they were instead to produce hydroxide themselves for $500 or $7,500 a ton, they could save $25 billion over 20 years. and, as importantly, have guaranteed supply security. After deducting 3 to 5 billion in capex, a 20-year savings of 20 billion discounted back to the present at 5% cost of capital translates into a logic which could see Ford justifying spending $10 billion on purchasing advanced pre-production projects to establish a secure, sustainable, and scalable 100,000-ton hydroxide supply. Or for a typical 25,000-ton project, Ford can pay $2.5 billion. My scoreboard to the right can be considered a shopping list. The total market value of emerging projects is just $20 billion. Highlighted are USA and Canada projects. Green is rock, purple DLE brine, and brown clay sediment. Market caps range from just 100 million to 1 billion plus, very far away from 2.5 billion Fordlandia math. Zijin buying Lithium for $770 million is just the beginning, in my opinion. Take it from Ken Brinsden of Pilbara. If capital does not start to flow upstream, pricing will only get more extreme and assets will only get more expensive. FOMO Lithium. And with that, I'll turn it over to Rodney, but also just remind all of you to please register your email on our website, rkequity.com, and subscribe to Rockstock channel on YouTube for all RK Equity videos.
Okay, thanks very much to Adamas Intelligence for having Howard and I join. I'm going to be covering the EV battery metal trends. If we look at the executive summary and the key things that are going on in the market, one of the main things to notice is that COVID-19 has caused logistical issues. The battery supply chain has responded by growing inventory levels substantially. Our forecast is that cathode production in 2021 will be 1.2 million tons, up 70% year on year. And if you look at that converted into gigawatt hours equivalent, that's 640 versus batteries sold 460 and batteries installed 390. And why is that important? Well, many analysts continue to underestimate the actual demand for key battery raw materials, in particular lithium, nickel, and graphite, by only focusing on batteries installed or sold. But if you look at the demand level for batteries sold, that's about 430 to 450,000 tons. Whereas if you base it on cathode production, it's closer to 500, 520. And that's a material difference in why we think the market is tighter than was expected. So we're seeing extreme moves in lithium prices, given batteries make up the majority of total demand. And as time passes, we think the same market share phenomenon is going to play out for nickel and cobalt on the cathode side and for graphite on the anode side. So what's happening with EVs? Well, China is set to reclaim #1 spot as the EU CO2 penalties flatline to 2025. The consensus for global EV sales now for 2021 is around 5.8 million units. That's higher than what I anticipated. And the reason why, as Howard mentioned, I was conservative on my 20,000 ton price forecast. So China is likely to reclaim the #1 spot in 2021 and likely to retain that mantle in 2022, given that EU CO2 emission standards are flat between 2021 and 2025. So there's no stick until 2025 to make that shift. And that means OEMs won't face any penalties if they maintain 2021 EV sales percentages until 2025. And where does North America fit into this mix? Well, in particular, the US EV subsidies, if they come through, you're likely to see a 2030 North American market for battery cell demand being as high as 600 gigawatt hours or higher. The US is targeting an EV penetration rate of 50% by 2030. A number of the OEMs have been supportive of that number, given their plans and investments that they've made. Now, even if the US's penetration rate falls short of the target, the average USA EV battery pack size is likely to be close to 2 times that of China. And that's consistent with the differential in average new car sale prices and incentives. So the US, the average is around 41,000 for an average new car sale price. And if you add an incentive of around $10,000, that's 51,000. And China is about half that or less, as they are pulling EV subsidies. So even if the penetration rate is substantially lower in the US, it means that they're likely to have similar gigawatt hour cell demand in 2030. As an example, on your right, that's the Wuling Mini EV, the most popular full electric vehicle in China. The larger model is 13 kilowatt hours, the smaller is below 10. And that is compared to a Rivian, the SUV that has 135 kilowatt hour battery pack size. So you literally need to sell 10 Wulings to match one Rivian. And that's an extreme example, but as you'll well know, the GM Hummer, there's a number of big vehicles coming out in the US, and that's going to make a difference. So as we always say, it's not the sales, it's the cells that matter. So what's causing the and driving the cathode demand? Well, surplus battery production in China is certainly one of those. China's battery production is going into overdrive in 2021. The year-on-year growth estimate is 130% up. When one looks across to North America, there are lots of planned battery plants, but China still dominates cathode capacity. It's currently at about 75%, and that's going to 80 to 85% in years to come. Redwood's commitment to doing a low carbon cathode plant in the US is a good start. That will grow from 100 to 500 1,000 ton equivalent, and North America is likely to need a clean upstream development to feed that process. If we look at the estimated surplus of battery production above installed for 2021, it's 2 to 3.5 times the amounts seen in 2019 and 2020. And if you look at the LFP inventory, it suggests that there's material pent-up demand from Tesla. As you can see over here, it's 23 gigawatt hours of built-up cumulative excess battery production versus NCM of 12. So there's quite a lot of LFP inventory sitting in the system. So what is our conclusion? What do we see going forward? Well, EV sales are now outperforming forecasts. China again to be number one, but North America with EV subsidies is likely to compete, but in 2030 against Europe and China on a gigawatt hour cell demand. And we're seeing investments being made. More needs to be done upstream. But with US EV buyer incentives coming into play, that'll mean all three major auto markets will be competing for cells and raw materials, and that's likely to translate into more upward price pressure for key materials. You know, we continue to see gigawatt factory announcements, but with no guaranteed battery metal suppliers. We're seeing downstream now bid for upstream assets, as an example, CATL, and I'm sure, and Howard mentioned, we expect buoyant financing and M&A for advanced upstream assets to continue. And the question is, will low carbon projects receive premium valuations? They certainly are in the stock market and on Howard's scoreboard, and that may well continue to be the case as the cleanliness and carbon footprint become more important in the future. Thanks very much.